Hello, this is Beast McFeast with an introduction to option Greeks and the basics of how to use them. The Greeks are good to know because they describe how an option's price changes in response to market conditions. First, a warning. This is an educational video only. I do not endorse any tickers or trading strategies I might discuss. The examples I provide are just that, examples. Before engaging in trading options, learn what you are doing. Investing can be risky, and options have unique risk. So today we will be going over the four major Greeks and rho. You can use the knowledge of these to better understand what your options are going to do in different situations. Knowledge of this can provide you additional ways to profit in various market conditions. Delta is probably the most important option Greek. It's what most people are going to be discussing whenever they mention any of the Greeks. It ranges in value from -1 to 1. Calls are positive and puts are negative. The only way you're going to get a -1 is by actually shorting shares. So you can't buy an option contract with a -1 delta. The only way to get a +1 delta is by going long shares. You're not going to get it out of a contract. It's the theoretical limit. What it does, delta describes what your contract price will do if the underlying stock moves $1 in either direction. For example, if you had a call contract on ticker XYZ with a delta of 0.3 and XYZ moved up in value $1, your contract's value would move up 30 cents a share. The further in the money an option is, the higher its delta, the more sensitive it is to movement in the underlying. When you're buying an option, higher absolute delta value is more expensive. Another way to think of delta is a rough estimate of the chance of a contract ending in the money. So a 0.5 delta is basically an estimate that you have a 50% chance of that contract ending in the money. Now, I'm not saying it estimates that it'll be profitable. It just estimates that it will be at least 1 penny in the money. You might still lose money on a contract that goes in the money. Gamma, similar to delta, it ranges from -1 to 1 in theory, but it's not likely to be nearly that high. What it describes is how delta will change when the underlying moves $1 in either direction. Gamma also does not remain constant. An example of delta. Going to be pretty long here, but try to stick with me. If stock XYZ trades at $10 and you have an $11 strike call with a delta of 0.4 and a gamma of 0.06. If XYZ moves to $11, the contract goes up in value by your delta value of 40 cents per share, and the new delta becomes 0.46. It increased by the value of gamma. Gamma might then increase to 0.09. Vega. This Greek is always positive, though you can sell an option which would give you a negative vega in your account. What it does is it describes your option's sensitivity to implied volatility, and it is highest at the money. This can make options difficult to profit from because the most volatile tickers often move the most and have the highest vega, which means that they are priced higher. Theta is the enemy of people who go long on options. It's typically a negative value with no maximum value. You can sell an option or go short on it, which would result in a positive theta value in your account. This represents the daily value lost on a contract if nothing else were to change, often called theta decay. Now, theta is unlikely to represent the true value lost on your contracts day to day, more of a rough estimate. It's unlikely to be true because the underlying price is probably going to move, which would affect implied volatility, which will also impact the price. But it gives you an idea of the daily cost to hold a contract. Interestingly enough, the more time on a contract, the less theta is. It means the daily cost on a contract is much lower when the contract is longer. This is what makes leaps appealing to a lot of people. High Vega contracts have a higher theta value, meaning that a ticker with a lot of volatility in it and an option that's sensitive to that volatility will be higher priced, making your decline in value per day faster because there's simply more value on the contract to take. Lower delta contracts have higher theta. This is because lower delta contracts are more based on extrinsic value, which is essentially the potential of this contract to do something, rather than its value if exercised, which for a low delta contract is essentially zero. Rho. Honestly, it's probably the least important Greek. It describes how sensitive an options price is to changes in the federal interest rates. Changes in interest rates are rather rare, but they're expected to rise soon to help combat inflation. So this might come into play in the next 6 months. Thank you for watching. Please leave any questions or ticker recommendations in the comments. Good luck and get rich. Bye.